This podcast is for educational purposes only and is not financial advice. Welcome to the 15-Minute Investor. Today we're covering the housing market outlook for 2026, analyzing why the long-predicted crash failed to materialize in 2025, and how current monetary policies are expected to lock in the national unaffordability crisis. We've pulled together a lot of recent data on, home prices, interest rates, and what the Fed is doing to give you a really clear view of what's coming. Links and resources are in the description below. If you find this podcast helpful, please consider subscribing to the channel for more market updates.
Okay, so let's start with a look back. For, what feels like years now, the big story was the coming housing crash. It was always right around the corner.
Always. But when you actually look at the data, the national data up to the end of November 2025, it just didn't happen.
Not even close.
Not at all. The chart shows some flattening, sure, but not that huge drop everyone was forecasting. In fact, if you compare November 2025 to November 2024, home prices nationally, they actually went up.
Up by how much? By 0.7%. Now, it's a small gain, but it shows the underlying, stubbornness of the U.S. housing market.
Right, that 0.7% national number is so important. But like we always say, real estate is local. That average has to be hiding some serious regional differences.
Oh, absolutely. And you really see a clear split. We looked at the top 300 metro areas, and about a third of them, 98 to be exact, they did see prices fall.
Okay, and where were those declines concentrated?
Mostly in the places that saw that huge pandemic boom, like the Sun Belt, parts of Florida, and out on the West Coast. A lot of that froth is finally coming off the top there.
So some regional corrections were happening, but not enough to pull the whole country down. Where did the strength come from?
It came from the other two-thirds. 202 metro areas saw prices keep going up, mostly in the Midwest and on the East Coast.
Markets that were maybe a bit more stable to begin with.
Exactly.
Yeah.
A little less speculation, still absorbing demand from people moving out of those really expensive cities. And the weight of those 202 areas just pulled the national average up. So the story of 2025 is no crash.
But the lack of a crash doesn't mean things got better. Homes are still incredibly expensive. And the big question for 2026 is, does that change? Or does monetary policy just make it worse?
And that's where we have to start. The Federal Reserve, they're really the primary engine here.
Right. They've been cutting interest rates.
They have. And what's really interesting is the market expectation. There's a new Fed chair coming in May, and the consensus is that they will get even more aggressive with rate cuts.
So the goal is to stimulate the economy by making it cheaper to borrow money.
Precisely. And cheaper mortgages translate directly into more buying power, more housing demand,
right,
and more demand for the same number of houses. Well, that's a simple recipe for higher prices.
And that's just one side of it. You have this other huge factor, money printing.
An immense pressure cooker. It officially restarted on December 12th. We're talking about liquidity injections at a rate of $40 billion a month. $40 billion
a month, just created out of thin air and loaned into existence. For listeners who aren't economists, what does that actually do?
It dilutes the value of all the other dollars out there. You're spreading the same amount of goods across a much bigger pool of money. It is inherently inflationary.
And this isn't a new phenomenon.
No, you can look at a 25-year chart of the money supply, and it lines up almost perfectly with the climb in prices for, stocks, homes, everything.
I was just thinking the median home price back in 2000 was something like $119,000. It's just a different world.
It's a completely different world. And that brings us to the real problem for most people, the core of this unaffordability crisis.
Which is?
The wage lag. All these asset prices are getting inflated by monetary policy, but people's paychecks are not keeping up, not even close.
The government reported annualized wage growth is, 2.7%?
It is. But that number is almost meaningless when real inflation is running way hotter. Many analyses suggest the actual rate is closer to 6, 8, maybe even 10%.
So every year, the average person is actually getting poorer in real terms.
They are falling behind. And this got worse because of something really strange in a recent CPI report. The government couldn't collect housing data because of a shutdown.
Okay, so how did they handle that gap?
This is the critical part. Housing is the biggest piece of the CPI.
Yeah.
And because they had no data, they just put in a placeholder. They set housing inflation to 0% for that report.
0.
0%. And when you do that to the biggest component, it artificially drags the whole inflation number down. That's how we got that 2.7% figure when everyone expected something over 3. It's masking the real pain.
And you see that pain in the home buying numbers.
Oh, it's brutal.
Yeah.
First-time home buyers have dropped to an all-time low, just 21% of the market.
Wow. What's the normal rate?
Historically, it's been closer to 40%. So they've been cut in half, essentially priced out of the market.
And the ones who can buy are older.
Much older. The median age for a first-time buyer is now 40 years old. People are spending their entire 20s and 30s just trying to save for down payment. It's the definition of a crisis.
So that brings us to mortgage rates for 2026. The Fed is cutting, but the average 30-year fixed is still hanging out just above 6%. Why isn't it lower?
Well, this is a key distinction. The Fed has a lot of control over short-term rates, but the 30-year mortgage, that follows the long-term bond market, specifically the 10-year Treasury yield.
And the Fed doesn't directly set that.
Right. And that rate is staying sticky for two reasons we've already talked about. First, inflation expectations. Bond investors want a higher return if they think inflation is going to eat away at their money.
Which, with $40 billion a month being printed, seems like a safe bet.
A very safe bet. And the second reason is the slow process of de-dollarization. Global demand for U.S. debt isn't as strong as it used to be, which keeps yields, and therefore mortgage rates, higher than they otherwise would be.
So what's the expert consensus? Where do rates end up at the end of 2026?
The predictions are all clustered in a very tight range. And the answer is they don't move much. Realtor.com and Redfin are saying 6.3%. The National Association of Realtors says 6.0%. Fannie Mae is the most optimistic at 5.9%.
So the takeaway is we're stuck in this range between, say, 5.9 and 6.3%. No major relief is coming on the financing side.
None expected. And that's before we even talk about the supply side, the obvious solution. Just build more houses.
But it's not that simple.
It's a triple threat, really. Construction costs for materials are way up because of inflation and tariffs. Then you have a massive shortage of skilled labor, which drives up wages. And then you have all the local red tape.
Zoning, permits.
Exactly. So the builder has to price a new home very high just to make a profit. But that high price is unaffordable for most buyers.
Which creates this vicious cycle.
It does. When they can't sell, they have to cut prices. But when they cut prices, they lose the incentive to build more homes. So supply stays tight, which keeps prices high. The whole system is just misaligned.
So putting this all together for 2026, the National Association of Realtors is actually predicting a comeback with a 4% price increase next year. Given everything we've said, that sounds almost conservative.
It really does. You have the Fed pumping demand into the market while supply is structurally constrained. It's hard to see how prices don't go up, and this creates what you could call a market of haves and have-nots.
Explain that, because I think that's the key for anyone listening.
The haves are the existing homeowners. Most of them have these incredible mortgage rates, 3, maybe 4%. They're sitting on a mountain of equity, but they're also locked in by golden handcuffs.
They can't afford to move because their next mortgage would be double the rate.
Exactly. So they stay put. That keeps inventory incredibly tight, which only pushes up the value of their own home even more.
And the have-nots.
They're the first-time buyers. They're facing ever-rising prices and these sticky 6% mortgage rates. The barrier to entry just gets higher and higher. The wealth gap that is defined by home ownership is set to get even wider in 2026.
So the outlook is clear. No crash on the horizon. Instead, we have aggressive monetary policy, expanding money supply, and wages that can't keep up. It looks like the unaffordability crisis is just going to continue.
That's the most likely scenario. So to wrap up everything from this deep dive, we have 4 major takeaways for you to keep in mind.
Okay, first, the housing market did not crash in 2025. The national median price actually went up by 0.7%, even with some regional declines in the South and the West.
Second, the big drivers for 2026 are the Fed. Aggressive rate cuts and the restart of $40 billion a month in money printing are designed to boost demand and fuel inflation.
Third, the core of the crisis is the wage lag. The official 2.7% wage growth is being dwarfed by real inflation, which is why first-time buyers are being locked out, and the median buyer age is now up to 40.
And finally, don't expect mortgage rates to save the day. The experts agree they'll stay in that 6 to 6.3% range, held up by the bond market's fears about long-term inflation.
Thanks for listening to the 15-Minute Investor.